Over to you, Shereen.
Thank you very much, Shruti. Chief Economic Advisor, thank you so much for joining us here this evening. We've got a packed audience here in Mumbai, and we were hoping to have you join us in person, but we understand that the GDP print is a much more significant event to deal with. So let's get started with that, sir. The number coming in at 6.7%, a tad below the CNBC-TV18 poll of 6.8%. For the benefit of our audience who are here in the room and those who are watching, explain to us whether this is materially the election impact that's played out on the GDP print, and whether you believe that growth continues to be robust going forward.
Thank you, Shereen. First of all, I would have also very much liked to be there, and therefore my apologies for not being there, and also my sincere thanks for you and the organizers to accommodate me to be able to participate in a virtual mode. Regarding the GDP print, I think first of all the good news is that there is an alignment between the production side and the demand side, and most components of the demand side have held up very well and have expanded compared to the first quarter of last year. And as you said, yes, the election season might have had a hand in it, because government final consumption expenditure as well as and also gross fixed capital formation would have probably moderated in the first quarter compared to the previous quarter, leading to this compared to the previous year's first quarter, leading to the slight slowdown in the growth rate. But as I mentioned in my press conference that concluded a little while ago, I think the broad momentum of the economy remains very intact, and I think we do expect that with the monsoon having been good so far, hopefully it doesn't turn out to be too much of a good thing. I think we can look forward to gradual improvement in the GDP prints in the coming quarters.
You know, you spoke about the fact that we should expect a gradual improvement. 7%, is that the expectation now on a sustainable basis, CEA? And also, you know, you talked about the monsoons. That was one of the red flags that you'd highlighted at the time of the presentation of the economic survey as well as the budget. But that concern is less of a concern today, and that's the indication that we get from industry as well. And you kind of alluded to that. If that's less of a concern today, is there something else that's overtaken monsoons in terms of concerns?
So sorry, I just didn't hear which concern of the various risk factors that I highlighted during the economic survey presentation.
The monsoons, sir.
Which one you're referring to?
The monsoons.
Yeah. So thank you, Shereen, for clarifying that. I think monsoon deficit is no longer a concern. If anything, you know, as a news report in today's Business Standard points out, if monsoon were to overstay its welcome, and in terms of first of all, we now know that deficit monsoon divisions, out of 36 monsoon subdivisions, the deficit divisions have become very, very few in number. And there is a large number of monsoon divisions which have had a normal rainfall, which is plus or minus 19% of the long-term average, and that's a good thing. But there are also quite a few subdivisions that have experienced excess, and a very few large excess. I think if, as we head towards late September, October, if the monsoon is still active, that might have some spillover effects on the harvest of the kharif crop. So that we need to watch out for. But at the moment, the good news is that the reservoir levels are much higher than last year's, as well as the average of the last 10 years. So that's a good thing. So I must say, therefore, on balance, the concerns with respect to monsoon have probably subsided than what it was when I made the presentation during the economic survey. But nonetheless, I think we are comfortable at this point here in Delhi to maintain the fact that our expectation for the full year's growth will be between 6.5% and 7%, and we don't intend to make any change at this point. We'll wait to see some more data for the second quarter before we can form a more definitive view on where the final outcome might end up edging towards or leaning towards.
You said the deficiency of the monsoon is less of a concern today. So let me address some of the concerns that you might be thinking of today. And you kind of alluded to that in the North Block's monthly economic report that is released. And that's based on what the RBI surveys are suggesting, both in terms of consumer confidence as well as manufacturing. Any rising concerns on both?
Yeah. No, not rising concerns, and I think the fact that the consumer confidence headline index declined, and also we saw perceptions on employment from consumer side, which had improved very steadily from the very low levels reached during the COVID pandemic, had shown constant improvement, and we would have liked to see that head into positive territory. But I think the consumer sentiment on employment, consumer perceptions rather on employment turned negative, and it was a negative in the June survey of the central bank of consumer confidence and in the August survey as well. Of course, it is not necessarily the case, therefore, that there is less optimism on jobs per se. It may well be the case that there is less optimism on the kind of jobs that people are looking for, and therefore the kind of jobs that they were getting. Hopefully the budget's various incentives on job creation in several sectors, particularly focused on manufacturing, will bring consumer perception on employment back to positive territory. So that is one area of concern, and also the industrial outlook, because I think while capacity utilization is very high, and we saw in the first quarter GDP data that private consumption is holding up quite well. Nonetheless, there are concerns in the industry about dumping, about excess capacity in China, for example, and that might also make them a bit cautious going forward about production, accumulation of inventory, and their capital expenditure plans. So in that sense, it was quite heartening to see the RBI monthly bulletin of August, which shows that private sector has been raising money, as good spending plans with investments in the next several years. So hopefully both these indicators are temporary and short-lived rather than harbingers of a trend. Back to you.
You talked about the fact that we are probably seeing dumping on account of the excess capacity in a market like China, and that potentially is impacting sectors back home in India. Do you believe it is time for further intervention? We do see the government regularly intervene by way of duties and so on and so forth, but do you believe that there is a case for intervention, and if yes, in any specific sectors that you believe have been identified or on the watch list today?
So Shereen, I must say that the audio is a little bit on the lower side. I don't hear everything very clearly, what you are saying. But nonetheless, I think if I'm not mistaken, you alluded to the question whether we have identified which sectors are particularly vulnerable to this issue of excess capacity and dumping. Was that the question?
That's correct. And if you believe that intervention by the government is warranted today.
Okay. That is difficult for me to say. It's premature at this stage, and I think the exercises are going on, and I'm sure the industry will also be giving its feedback, and therefore it is not fair on my part to comment whether at this stage there is a particular action that is warranted. But we should be aware that the last time when we had a non-performing asset cycle in India between 2012 and 2018 or 19, apart from many factors, one of the causal factors was post-2008 financial crisis, disappointment in global growth, and the stimulus that China gave post-2008 crisis also led to massive excess capacity and dumping of steel, for example, which had an impact on global steel prices, resulting in distress in several steel companies in India. That is sort of a memory from the past that we should not forget, because the implications of this may well go beyond capital formation, inventory accumulation, slower GDP growth. We also want the current financial cycle in the country to last longer, and therefore we need to examine this phenomena from multiple angles.
Well, since we're talking
Back to
about trends that we need to factor in as an economy and as a country, the big topic of debate here at the Banking Transformation Summit (CEA) is the issue of deposit growth and deposit mobilization and what that means for India's banking sector. And this is something that the survey also talked about as a potential cause of risk. And the move that we've seen towards the capital markets, for instance. In that context, I want to also bring up something that you tried to dispel, that the fall in household savings was not a sign of distress, but was a sign of diversification. So how do you see this playing out in the long term, and what are the implications for India's banking sector as we see this challenge of deposit mobilization and deposit growth?
No, I think I have very little to add to the excellent articles that have appeared from several of my friends in the industry, and including by Vivek Kaul in Mint today, on the misunderstanding and the misperceptions on deposit growth and credit growth. And Vivek correctly refers to the Bank of England paper published in 2014 that loans create deposits, and even if investors are the public is shifting to capital markets, I think the money eventually comes back into the banking system as deposits. So I think it has different causal factors. I don't think the inclination of Indian public to save via the capital markets is the reason for low deposit growth, because then one needs to look at money creation in general having a role in deposits growth. So I think this is not the right framework to examine the widening gap between credit growth and deposit growth. Now, as far as the household savings are concerned, in fact, not only the case that households have been diversifying and from financial assets to real assets, it is also the case that our measurement of financial savings may be on the underestimation side. I think right now the capital market regulator and the central bank are engaged in an exercise of looking at it and seeing whether we are capturing all the primary and secondary market investments, mutual funds, single stock investments that Indian public is making in our overall measurement of financial savings. So the issue that has been flagged may very well lie in the inadequate capture of the data rather than a real problem with household financial savings.
Okay, point taken.
Back to you.
Point taken, sir. Let me address the other point of debate here at the summit, and that is whether we've peaked or the best is behind us as far as the banking sector performance is concerned. At least for now, we've had a stellar last few years, particularly the last year has been a record-breaking year on many fronts. Of course, banks find themselves very well capitalized at this point in time, so that balance sheet problem has largely been addressed over the last few years. How do you read the trends, the signs? Does the government have a view on whether there is likely to be a deterioration in asset quality? And is there a view within government on what the next few years could look like for Indian banking?
No, I don't think there is any concern at this point about deterioration in asset quality in Indian banking. The regulator, Central Reserve Bank of India, has been doing a very good job of keeping on top of it. As we saw a few months ago, or rather towards the end of 2023, the preemptive measure they took on increasing risk weights on unsecured lending, etc. I think, and also the deployment of technology and to flag rising concerns. So I don't think there is any concern here about the asset quality deterioration. Nonetheless, of course, you pointed to the fact that banking sector performance was very good up until the financial year FY24. Therefore, naturally, given that the base has gone up quite considerably since the difficult days of the mid-2010 to 2020 period, it is natural that the growth rate moderates. And that's a good thing, because we want the financial cycle to be stronger for longer. And in fact, if there is a moderation in the net interest margin of the banking system as a whole, it isn't a bad thing, because we have seen, for example, in the United States pre-2008, when the financial sector performance or its market capitalization in the overall market cap rises much faster, it actually is a sign of imbalance rather than a sign of health in the overall macroeconomy. So some moderation and at the same time continued healthy growth isn't a bad thing. As far as the medium term is concerned, I think we do need to look at, given the investment needs of this country, both for normal infrastructure investment and climate-related infrastructure investment, and also for replacement demand, what is the level of savings and how can that be generated through income and employment growth, and how will the savings be intermediated through through capital markets and through the banking system? What should be the right debt to equity mix, and given that, what should be the size of the banking system in the country? Do we have enough number of banks, and why is it that we don't have a global bank that caters to Indian industries, investment interests overseas? Because many countries, whenever their industry went into another country, their financial institutions also followed suit. But for example, the Indian industries' overseas banking needs are still met by multinational banking industry. So these are all the questions that we need to contemplate, apart from the fact that the induction of technology should actually be geared towards making banking easier for our consumers other than more complicated. Because although the Indian demographic dividend is very strong, the aging population will catch up with us as we head into the mid-2030s onwards, and therefore making it more and more technology intensive will also make banking more and more difficult for our households. So we need to strike the right balance between technology, safety, security, and ease of use for the Indian public, and also with respect to employment generation, the application of artificial intelligence, etc., because banking industry is something that operates on trust. And people do associate trust with the human interaction. So those are all the questions that the industry need to contemplate for the medium term as far as Indian banking is concerned.
Since we're talking about contemplating questions for the medium term, sir, let me ask you about the journey that we've seen, and we've just clocked that 10-year milestone as far as the Dhan accounts are concerned. CA, what do you believe the next phase of evolution needs to be when we talk about Dhan accounts? Because while we've done a fabulous job in opening these mammoth no-frills bank accounts, but the fact of the matter is that we still have about almost 8.4% of the accounts, which is about 4 crore accounts, which are still zero balance. And anyway, these are meant to be zero balance accounts, but also inoperative banks, about 10.6 crore inoperative accounts at this point in time. So as we move beyond this 10-year milestone that we've clocked, what do you see as the next phase as far as the Dhan accounts are concerned?
Shereen, even if we are able to show that not the glass being half full, but 3/4 of the glass is half full, you are saying that the 1/4 of the glass is empty. I mean, that is a bit harsh and unfair.
No, that's not my intention at all. That's not my intention at all. I'm merely asking this in the context of the next 10 years. Now that we've opened these accounts, the next 10 years, what should the priority be?
Look, at the end of the day, I think these accounts are starting points, and then whether it leads to greater financial access for resources for growth, and ultimately the financial sector grows when there is employment generation, income growth, and savings rises. So therefore, the next set of growth for Indian public has to be to achieve the right kind of balance in their portfolio between financial and real assets, and also have a high sense of financial literacy. And more importantly, the concept of insurance is something I think that needs to grow along with the spread in banking. So these are all the next steps that we need to contemplate as the Indian public overall achieves a higher level of financial inclusion than we have seen in the previous decade. So I would expect that these are the next milestones or areas of attention from the policymakers, from the industry and regulators, etc.
Sir, speaking of the next milestones, something that is much more immediate, of course, is the base year revisions, both as far as GDP and CPI are concerned. When can we expect that? And do you have a view on what those should be?
I don't have a timeline at this point to share with you, but I'm aware that the Ministry of Statistics is very much actively engaged in the process of addressing not only the base years, but the constituents and the weights of various indices, and then leading to GDP base year, etc. And the 7th economic census, index of industrial production, also looking at launching producer price index series, revising the consumer price index. All those exercises are very much underway. Perhaps you should have a conversation with the Secretary, Ministry of Statistics.
We will try our luck with that as well. My final question, CA, before we let you go, let's talk about the global environment. We've, of course, just seen the Fed chief speak at the Jackson Hole Summit. We've had the MPC minutes come out as well. One, on the commentary that's come in from the Fed, what do you make of that as far as the global interest rate trajectory is concerned? And what did you make of the MPC minutes as well?
Shereen, I have never commented on the monetary policy stance in India in public, and I'm not going to mar that record now. As far as the Federal Reserve is concerned, I think it will be presumptuous on our part to tell them what they should be doing or what they ought to be doing. But I think it does look like the Federal Reserve, and even today as we speak, the personal consumption expenditure price index data have come in on the lower side. At the same time, we had the GDP data for the April to June quarter was revised higher. Of course, one can always say that that is a historical data. And looking ahead, I think there has been a certain softening of employment figures and softening of the inflation figures as well in that country. Maybe the financial markets, rather than commenting on what the Fed will be doing or what they ought to be doing, what I do feel, however, is that the financial markets may be discounting rather aggressive and faster pace of rate reduction on the part of the Federal Reserve than what they may actually do. This is just my guess at this point, wearing the hat of a capital market participant from a different era, from an earlier era.
Well, since we're talking about eras, sir, my final note to end this conversation on, we're talking about the future of banking and how we expect banking to transform the country and transform itself as well. What would be the pillars of transformation that you believe the banking sector needs to prioritize and really to be able to achieve that $10 trillion aspiration, which is the more immediate aspiration? Do you believe the Indian banking system is geared to deliver for that?
I think the Indian banking system as a whole, that includes the industry participants, the regulators, etc., need to tailor their approaches to the Indian context. We need to be aware that some of the principles and practices we import from overseas may not necessarily suit the context of a developing country where many small and medium enterprises still do lack access to finance. So whether it is in insisting on certain external credit ratings, some of these things were flagged by the Honorable Finance Minister in the budget speech as well, classification of accounts into special mention accounts, SMA 0, 1, 2, etc., and what they actually do during this period to nurse the accounts back to good health. And therefore, access to credit is extremely important aspect. And second, at the same time, the low-hanging fruits of credit are always about personal or consumer loans. But there again, I think the banking industry should be mindful of the fact that one should not kill the goose that lays the golden eggs, that is over-lending, or for that matter, over-borrowing on the part of the financial sector, or the part of the household sector, will eventually prove detrimental as the financial cycle will enter into a prolonged downturn, as we saw in several countries in East Asia and probably are seeing in China at the moment, for example, or for that matter in advanced countries post-2008. In other words, I think one important behavioral aspect that the industry has to keep in mind is moderation in terms of growth and in terms of credit culture will stand India in good stead, and also ensuring that whatever we do, we tailor it to the Indian context and the fact that we are a low-income aspirational country wanting to become a middle-income status. We need to sustain our growth rates, whether it is economic growth or credit growth. So whatever that needs to be done to sustain them, and that includes delayed gratification on the part of the banking industry and the non-banking industry. Those would be my sort of ideas or priorities for the banking industry for the medium term. Back to you.
CEA, thank you so much. I know it's been a very, very busy day for you, but we truly appreciate you taking the time out to speak with us here today and address the gathering of bankers, NBFCs, fintechs and policymakers here at the CNBC-TV18 Banking Transformation Summit. We truly appreciate your time and thank you very much for leaving us with that thought of the Indian banking sector playing a Rahul Dravid-like innings. We truly appreciate your time. Thank you very much. Ladies and gentlemen, a big round of applause for the Chief Economic